Welcome to the Daily Drawdown, where rates, AI spending, and market risk are moving together. The Fed just made a September rate hike a live possibility again, while the AI build-out is running into a harder question: who pays and when do the returns show up? That combination is pushing investors toward protection even as major indexes hold near their highs. Kevin Warsh's Jackson Hole message landed hawkish. 12-month PCE inflation stood at 3.7%. The 6-month pace was slightly above 4%, and inflation has run above the Fed's target for 65 months. Markets responded quickly, lifting September hike odds from roughly 30% to 40% into a range around 52% to 60%. Warsh focused on breadth as much as the headline. 54% of 199 PCE components rose more than 3% over the past year, and 49% did so over 6 months. Those readings have improved from the post-pandemic peak near 77%, yet they remain well above the pre-pandemic norm around 32%. The decision is still contested. One camp sees a 25 basis point September hike unless inflation softens materially. Another expects a hold, with December as the next possible move. One estimate says core CPI may need to print near zero to prevent a September hike. The broader point is that the policy stance may still be loose. Taylor Rule estimates put appropriate rates 100 to 200 basis points higher, while the Fed's stated neutral rate near 3.1% sits below the 3.5% to 3.75% policy rate range under discussion. Warsh also challenged the Fed's communications framework. He rejected routine forward guidance, detailed rate paths, and potentially the dot plot because quasi-commitments can quickly become stale. His concern is a hall of mirrors. Markets trade on expected Fed action. Then policymakers use market prices as signals. That feedback loop can magnify errors and deepen dependence on the central bank. Instead, he highlighted 6-month inflation, breadth, private domestic final purchases, credit spreads, earnings growth, and inflation expectations. Investors get more Fed discretion and less visibility into a mechanical reaction function. The post-speech bond move reflected that tension. 2-year yields rose about 7 basis points, nearly 3 times the 10-year move. Long yields also rose, with the 10-year discussed around 4.7% to 4.75%, versus roughly 4.2% at the start of the year. Front-end yields are repricing Fed policy. Long-end pressure reflects Treasury and corporate issuance, AI infrastructure borrowing, growth expectations, and term premiums. With more than $1 trillion in annual federal interest expense and roughly $8 trillion of refinancing over the next year, sustained yields near 4.7% could add about $110 billion to interest costs. The case against an immediate recession remains strong. Unemployment was 4.1%. Real consumer spending rose more than 2% over 4 quarters, and private domestic final purchases were growing near 3%. Business investment in equipment and intangibles was up about 9% year over year. S&P company profits rose more than 20%, and credit spreads and lending conditions showed limited signs of severe financial restriction. Manufacturing is the obvious weak point. Chicago PMI fell to 47.1 in August, below the 50 contraction line and far below expectations near 58. Watch whether that weakness spreads into employment, CapEx, and consumer demand. AI remains the market's central growth engine, though investors have shifted from asking about model capability to asking for returns on capital. The next phase centers on inference, specialized workloads, and enterprise deployment. The scale is extraordinary. Reported capital expenditure commitments include about $1.5 trillion for OpenAI and roughly $400 billion for Anthropic. More than half of recent CapEx growth may be tied to AI infrastructure. The key risk is financing. IPO markets, secondary issuance, debt, supplier financing, and strategic partnerships all need to remain open. A deleveraging cycle or a closed capital market could interrupt the build-out even if AI demand stays real. NVIDIA illustrates both sides. It reported $96 billion of revenue, including $89 billion from data centers, and guided the next quarter to $108 billion. Forecasts still project growth as high as 70%. At the same time, reports that NVIDIA has discussed backstopping up to $125 billion of customer and supplier deals, including potential OpenAI support, have sharpened questions about revenue quality. Investors are watching for double-ordering capacity reservations ahead of proven demand, and any signs that financing support is substituting for end-user economics. The more durable beneficiaries may include the infrastructure plumbing. Data center interconnection ports could rise from fewer than 1 million today to 20 to 40 million by decade end, supporting Ethernet and connectivity suppliers such as Cisco and Arista. Broadcom also stands out as hyperscalers pursue custom chips and inference capacity. Physical resistance is becoming another constraint. Lawmakers in at least 15 states have proposed data center moratoriums. Morgan Stanley estimated $156 billion of projects were canceled or delayed in 2025, followed by another $130 billion in the first quarter of 2026. Power costs, water systems, and local approvals now matter directly to the AI investment timeline. AI could eventually lift productivity and ease inflation through the supply side. The timing remains uncertain. Earlier technology waves took years to appear in aggregate productivity data, and recent gains have flattened. That uncertainty matters for rates. Stronger productivity can support growth and equity earnings while also sustaining capital spending and elevated yields. A sharply hawkish Fed risks underestimating AI's longer-run disinflationary potential. Cybersecurity is gaining from the same deployment cycle. Companies need stronger identity controls, data governance, access management, and protections for autonomous agents. CrowdStrike rose 20% after earnings, Okta nearly 30%, and the BUG Cybersecurity ETF gained 16% for the month. Security executives warn that AI models cannot reliably defend themselves. Hospitals, water systems, internet infrastructure, and other essential services face increasingly automated threats. CrowdStrike and Palo Alto Networks are among the companies building defenses against rogue agents. Apple is entering a consequential handoff as Tim Cook moves to executive chairman and hardware chief John Ternus becomes CEO. Cook remains central to Washington, Beijing, regulators, trade, and supply chain diplomacy. Ternus inherits the product cycle, including the iPhone 18, possible foldable hardware, camera-equipped AirPods, and the unresolved task of explaining how Apple monetizes AI amid compute constraints and slower services growth. Equities absorbed the hawkish repricing relatively well, led by mega-cap technology. The Russell 2000 lagged in one discussion, falling roughly 1.2%, which fits a market where higher rates pressure smaller, more financing-sensitive companies. Protection buying is elevated despite low volatility. VIX calls outnumbered puts by roughly 5-to-1 to 8-to-1, and one trader spent about $9.5 million on more than 100,000 October VIX 28 strike calls. The market is priced for a smooth macro outcome, stable Fed policy, durable AI capex, and limited fear. The pressure points are clear: incoming inflation data, September Fed expectations, long bond yields, AI financing conditions, and whether corporate earnings keep validating concentrated technology leadership. For diversification, investors are also revisiting cash-generative and less narrative-dependent areas, including fertilizer, healthcare, and precious metals miners. A more volatile rate regime calls for broader exposures than a single concentrated growth trade. That's the standing brief from the Daily Drawdown. Watch the inflation data, the long end of the Treasury market, and the evidence behind AI spending. This episode was generated by Podkey. Create your own at podkey.fm.